Hi, good morning, everybody. Thank you all for joining in on a Saturday morning. So today's topic is on the global markets and whether there is an opportunity that can open up. Right. So let's look at the landscape now. What's happening with our interest rates, right? You're seeing 2 years where from COVID your interest rates have gone up. They've been the highest since 2003 2005 cycle, right? And the expectation is that there would be a cut. Right? Even in the previous Fed meet that just happened, they said that there is no expectation of a rate cut, but definitely going forward in the year, they want to consider doing it sometime in June or later in the year. Right? But the expectation from the market is that it will be very swift and fast, but that's not a good expectation to have, right? But what you must see is that the interest rates have gone up too fast. Right? If you look at the previous cycles, look at from 2015 all the way to 2019, it's taken 4 years for them to slowly increase the interest rates and then suddenly drop it. Right? But the whole point is that this cycle has been very swift because of COVID, and that has led into deeper problems in the entire economy. Right. So globally, things are in line for a slowdown. You are not seeing a slowdown at the headline number because everybody is just looking at the markets. But the whole point is growth has to be very broad based, and growth is not very broad based. It's only coming in from particular segments of the economy, right, which is not sustainable. So the whole point is that things are looking not very confident. Right? There are talks of slowdown. We are already in some sort of a slowing economy globally, right? Not India. India is a country that is poised to grow at 7% sort of growth rate. But globally speaking, there is some bit of slowdown. Now, let's look at what the central banks have been doing. So if you look at COVID, after COVID, there was a flux of liquidity that came into the system. It's not only from the Fed, it came from all the banks, uh, all the large banks, right? All the G7 countries. Right? So if you look at Japan, Japan also participated. If you look at England, England participated. The European Central Bank participated a lot, and now they are trying to pull back that liquidity, right? So the forecast is that they would pull back that sort of liquidity. But if you see in from 2020 all the way up until 22 23, still there have been purchases that have been happening, right? It's not that liquidity is not being pumped in, but yes, liquidity is being pumped in. So this is something for us to look at. This is something to look at how they are going to pull back that sort of liquidity. But such big inflows that keep coming in, it's very unlikely that the entire thing would go away. Uh, yes, there would be some developments that come into this place, but this is a problem for the entire world. Flux of liquidity usually means high inflation, and high inflation usually means high interest rates. Right? So that's the sort of economic environment that we are operating in now. If you look at the debt, now debt is very, very important when it comes to looking at macros because it gives you a sense of the underlying uh, strength, the fundamentals of that particular country. Right now, if you see your real uh, treasury yield, which is the long-term treasury yield, is not beating inflation. So anyone putting money in debt in the US, which is one of the largest markets in the world, does not make much money, right? Inflation adjusted, they don't make money, right? So what does this mean? Even your debt is not giving you return. So naturally, people will go to the next asset class, which is a risky asset class, which is equity, right? And within equity, they would, as you know how equity works, people would take all sorts of risk uh, to make that sort of extra yield, right? But US is a very peculiar case because here you are having large caps that are becoming multi-baggers. Right? In India, your small caps are becoming multi-baggers, but here in the US, you are having large caps that are going out and becoming multi-baggers. Right? It's a very strange, it's a very peculiar scenario. Right? But the point is for debt, uh, high inflation is not really good for debt. So real treasury yield, you don't really go out and make any money. Anybody putting money in US on the debt side does not actually go out and make actual real money, right? Nominal, it might look good, but the yields have dropped significantly. They've had a sharp rally also, which is good. It gives us a very short term sort of an opportunity. You have to go dive. You have to dive. You have to dive deeper when it comes to taking an exposure on the US debt side, right? But the economic environment that we are working with is that there's a slowdown, and debt does not give you that sort of big opportunity in the developed markets. There are particular parts that are giving you that opportunity, but broad based, there's no big opportunity that's coming up, right? There are pockets. Before the Fed meet, there was a pocket that actually gave a big opportunity for US investors, not for Indian investors, but definitely for US investors, right? Now, if you look at rates and what the expectation is, right? The implied rate is that it would come down and it would normalize, but that is definitely not the case that's happening right now. So if you look at the how countries are taking rate hikes and rate cuts in their mind, if you look at the US and Europe, right? There, if you see, there has been uh, continuous rate hikes and no sign of cutting back. Right? But if you look at Japan, Japan has stayed at 0% interest rate and less than that for a very, very long time, right? Because they have to support their economy. So there's a decoupling of interest rates that happening, right? Naturally, when there's a decoupling of interest rates that can happen, uh, your currencies also would uh, be decoupled, which means that they would move separately than what it would how it used to in the past. So you have to look at things very, very differently, right? So Indian currency has appreciated against all the other currencies except the US dollar, right? And US dollar itself has been weak compared to other countries, which means that everybody's currency is sort of getting weaker in the developed market side, right? But India has strengthened against everybody. Our relationship trade relationships definitely play a role when it comes to currency. But the point is that there is a decoupling of interest rates that is happening. So every country for themselves, they will do what's best for their country and their country's growth and managing their inflation. Right? That's what is happening right now. So the assumption is that there would be an increase in Japan. Not very sure of what can happen, but the assumption is that yes, it can happen, right? Because now they've gotten inflation which they have not seen in the last 20 years. Nobody got that sort of inflation. Japan did not. And now it's actually benefiting them in certain aspects. Right. Now, growth. India, like I said, only country that is giving you 7% odd sort of growth, which is a very, very good thing, right? Which is a very good thing. Indian country is the only country that is giving you that sort of growth. No other country. If you look at China, China projections have dropped significantly. Uh, in this sort of a scenario where there's high inflation and when there's high interest rates, usually your developed nations don't actually give you that sort of growth because they're so large. It's difficult for them to uh, control whatever problems that can come in. Right? So your emerging nations perform very, very well. So US, Europe, UK are not in the position to give you big growth. Yes, 2.5%. That's the assumption. It's good for a developed nation, but emerging definitely stands out during such scenarios where there is inflationary issues and there are high interest rates. So any country that is offering a very good balance sheet to foreign investors definitely will get a lot of inflow. But now, since our market is getting heated up, we have to look outside. We have to look at where we can get that sort of opportunity outside, right? Because opportunities will now present themselves because they are lacking growth. So opportunities would present itself. And now where do we need to look at? Now, a poll. Which one do you think is the best performing global index in 2023? So you can put your answer in the chat box. Okay. A lot of you have said India and US. You're still neck to neck. So a couple of more votes and we'll move on. Okay, so I think a lot of you have said US and India. So US is one of the best performers in 2023. India stands very good at second, and if you look at developed nations, developed markets, ex of US, they've also done phenomenally well. But if you look at the chart, right, there have been times where India has done very well. There have been times with the US has done very well. But a majority of the time, since 2015, the US has sort of come out on top, right? Uh, uh, Even when a bad scenario does come in, India does not fall that much. But incremental returns that come in. So 18, 19, and 20 is when we saw a deep slowdown in India. And that's what happened. It was reflecting in the equity returns as well. But the madness that goes on around the US markets are very high. So if you see, everybody has sort of piled money in the US, and it's one of the largest markets in the world. So let's look at within selected countries who has actually gone out and done well. This last year has been Japan's year, Japan and Taiwanese year. But you already have been reading a lot of news. It comes on to your YouTube, it comes on your Twitter, in your newspaper, saying that no, Japan is back. Japanese markets are very, very attractive for you to invest in. We keep getting queries on is Japan a good market for us to go out and invest in? Even yesterday, everybody got that sort of notification that Japanese markets have hit an all-time high. Now, one thing that people don't really see is they've hit an all-time high after 34 years. So 34 years as a long-term investor, when you invest for more than 10 or 15 years, you want to go out and start getting that return. But somebody who's been saving for nearly 30 years in the Japanese market, so the Japanese have not made any money for the last 34 years, and now is where they are actually going above that, right? So you can't time the market, but you can look at when you look at saving, you look at only from a long-term perspective. You look at only 10, 15 years plus. We say 10, 15 years, but your actual great time period for you is after that. So it's almost 2 decades. But the point is you don't see that sort of long-term return when it comes in when your macros are not really looking good. And we are in a scenario globally where macros are not really looking that good, but you're seeing high equity returns coming in. So because of inflation, you're seeing riskier assets do extremely well. So the risk appetite of people is actually going up because they want to beat that inflation. So there's irrationality in the market that's going on. Right? Other nations have not really done well. If you look at 15-year data for Japan annualized returns are somewhere around 6%. So you're compounding at 6%. Right? What do you think is the annualized return when you compound in India for 15 years? Anybody that knows the answer can just put it in the chat box. What do you think is the 15-year, annualized returns that you can get when you invest in India? 11 to 12, 12 to 15. Yes, you get somewhere around, 11 to 14, something like that. Definitely, that's the right answer. Right. So somebody investing in Japan for 15 years has made only 6% sort of return. And just that things are changing right now, would you want to jump onto that wagon? No, you have to wait for it. You have to see what are the developments that are taking place, and only then try to take a call. Right? Their demographic profiles are much different than India. It's an aging nation. Again, China also turns out to be that country that has had a lot of outflow when it comes to foreign investments, and the sentiment has turned extremely negative. So I've taken a couple of points for China as well in the later stages of the presentation. You can just see some data. It's good data that came in. So definitely you must look at it. So 15 years, even China has not seen the sort of return. India is somewhere around 11 to 12. So yes, uh, uh, we still stand out even from a long-term perspective of 15 years or so. US has been very strong at 14.5%. Right. So this is where we stand in terms of other countries in terms of performance. So where are most investors investing globally? I think I've already told that yes, US is the place where investors are investing a major chunk of their money globally. Right? Even here in India, when we see those options, we are having a lot of ETFs that do Nasdaq, that do S&P 500. There are many fund of funds where we do want to go to that particular sort of market. Right now, let's look at that landscape. right? There's a high concentration in US, right? Majority of the funds, this is a global index. Now, a majority of their money, so people investing in the global index also will invest in the US. So 61% of all the money that is in that particular index goes into the US. The next is Japan. After that, UK, Canada, China. But there's no India. India is very small. India is just 2% of that particular world index, right? But a majority, 60% of that money is going into US. Now, where is it going within US? Right? Where is it going inside? Now, where is that going? They go in IT, right? They go in technology. That's why you see, all these IT companies. The minute people pour money into uh, US, into those particular passive indexes, naturally money goes into these areas, and money has been going into these areas. Today, you're seeing more multi-baggers coming in, more names doing extremely well, more technology-oriented companies, the top seven doing extremely well compared to the rest of the entire market. Now, where do you think the concentration lies in India? So, for example, let's say that the money comes into India. Where do you think that money is going to come into India when they just look at a passive sort of investment? Somebody said yes. Oh my God, US 61%. Yes, that was our reaction, my reaction as well. But it's not. It's a known fact, right? So in India, banking and finance, yes, and banking and financial services in India are trading at very dirt cheap valuation, right? So anybody on M2W would know how we are trying to help you to invest in certain sectors, certain parts of this particular market. So IT gets a majority in the US. Then followed by financials. Financials is not so big, right? They are already pretty large. They are going through some bit of a turmoil in terms of asset quality. And the rest is healthcare, industrials, and everything else sort of comes in. But a majority goes into IT. 24% of that money goes into IT. Now, this is that landscape that I was telling you about. Today in the US, there are about 3,421 ETFs, right? There is a 10% change. There have been more ETFs launched, right? There are 550 ETFs launched, and they're very evolved, right? We get many products that you can invest in, many themes that you can invest in, many sectors that you can invest in the US. Here you have fund of funds that take advantage of certain parts of that particular market, right? But here, where as investors we want to go towards very exotic products, I would say. So you have where the demand is, you would have that sort of supply. Naturally you have more exotic products as the demand goes by, right? You have AI, artificial intelligence, and all sorts of products that are coming in. You have real estate ETFs, fund of funds in India, which I think uh, is not needed here. We still have to develop that trait of investing systematically, and then taking care of asset allocation. So that's more important, right? So there are there's $8.2 trillion worth of assets in US ETFs, right? And that keeps changing naturally because of some sort of change whenever it comes in the market. But either ways, 8.2 trillion is the current number for these ETFs, right? A majority of these ETFs are listed on NYC. So the index itself is NYC, and then there's NASDAQ. But what you need to look at is the number of ETFs that are there. There are 3,420 ETFs, and in India, it's just a fraction of that. And I had done a webinar on where passive money is going in India, and you would be surprised to know that a lot of passive money is just going into broad-based indexes, which is Nifty 50, and your government indexes, which is your CPSE and your debt that is there on your government bonds, your G6. So majority of the money is going there. So we are still very nascent. We are still maturing as investors in India. For us to take a sectoral call, for us to take a thematic call, that's where your Milestones2Wealth does come in, where we are able to position you well, in the right parts of the market at the right time, right? But Indian ETFs are very, very nascent. Look at US. US has 3,400 ETFs. It's a mix, sectors, themes, countries, all sorts of innovation takes place. Debt, all sorts of innovation takes place in the US. Right? Complex products, complicated products, and simple products. That's the key. So 550 have just been launched, right? Uh, so what do you think is leading to this overweight on technology in US? Is it AI, blockchain, clean tech, cloud computing? What do you think is that factor that is leading into overweight in technology? And I put AI for a reason. Let me tell you that. Okay, very simple answer, right? AI, and then there's cloud computing. Yes, AI, cloud computing is always there. But is it real? Is it a hype? Is it a bubble? Let's look at that. Yes, it's overweight and people are paying absurd amounts of valuation for these businesses. Is Does it warrant such hype? Does it warrant such overvaluation? Now, uh, these are the new areas of growth, right? Uh, and this is all public data. This is nothing that's something that we've collated or something. Everything is public data, right? So if you see uh, robotics, health tech, enterprise tech, digital payments, on-demand consumption, all of these are theme that are offering growth opportunities globally, right? Especially in the US, these are businesses that are majorly there here and China. But the point is that yes, these are themes that are the next wave of growth for the world, and naturally, the entire investment fraternity would want to look at these businesses and obviously want to be early at that particular uh, uh, before those particular chain of events take place. You want to be early to the party. Naturally, you would want to look at these businesses and want to be early to that particular party. So you look at this again. There is digital payment, which is again cloud. Again, there's health tech, which is tech, robotics, AI. So AI comes everywhere, cloud comes everywhere. Naturally, you would see that investor interest going up in all these things. Now, this is a very important slide, which is good. Right. Uh, this is thematic adoption by phase. Which phase are we in? What are all these things that we are talking about? And when you hear somebody say clean tech, when you say wind, when you say Internet of Things, where are they in the phase of adoption? Right? Are they being adopted by everybody so that they should warrant this sort of valuation, or is it still in the nascent stage? Right? Where are they? Now, if you look at the phase majority, right? Early majority, right? They are all in fintech, which is just being used. So you see, India, you see UPI, you see all the other fintech innovation, you see fast tech. This is globally, yeah. This is not particularly India, but you can get a sense of where India lies here, right? If you just plot a chain for India as well, here you would see we are in early majority, right? We are still having ONDC that's coming in new for us. So we are again on the early majority sort of phase. So globally itself, fintech is at an early majority phase, right? Renewable energy again early, right? Then if you look at cyber security again, it's early. If you look at e-commerce, now penetration for e-commerce has been very large, right? Today we are ordering things left, right, and center. No, it's not only us; it's the world, right? So that is coming into a later stage in terms of innovation, right? If you look at cloud computing again has come into sort of, they are already in a very good stage because they've evolved, right? Cloud computing has not just come today; it has been there for a long time, and it's just getting evolved. There's more innovation coming up in this space. Social media, everybody is using social media now. If you look at Meta's numbers, you get to know how many people are using social media. Everybody is using social media, right? Video games, esports, everybody has come, right? So data centers again has come onto this sort of uh, uh, late majority side, right? But if you look at the early adopters, you look at the innovators, there you see a lot of crowding that's happened, right? AI again very early, robotics again very early. All the things that led to this sort of growth, right, is all very early. Digital health early, Internet of Things early, carbon credit, lot of articles on that early. Lithium and battery technology, EV, right? Battery tech very early. Blockchain very early. Hydrogen very early. Hydrogen has just come up now, right? So a lot of crowding is there on all the new age technology, everything that is warranting very high valuation right now. It's not proven at all. It's still on to early adoption. It's still on to its stage of innovation. A lot of it is there. So what has happened is that there has been a valuation mismatch when it comes to where we are in the particular cycle. That's why you're seeing. That's why people call this. Is it a bubble? Is this a hype? So whenever you hear that, you can plot this in your mind, saying no. Let me see where they are in that particular phase of adoption. If they're being adopted very well, then yes, they warrant that because they're generating high free cash flow. Their business is sort of generating now. That business is sort of generating, and it's a proven business model. Right? But if it's not, then you know that if it's not, then naturally it is a cause of caution for you. You have to think from a cautionary standpoint, saying no, I think that things have to play out. Just because for 1 2 years the returns have been extremely well because of some sort of a bubble, some sort of hype. Should I get onto that bandwagon? No. Should I enter the party? No. Party is going to be there. Right, party is going to be there. If it's not today's party, it'll be some other technology that comes in on that party. That's where you can go. But right now, definitely, it's still in early stage adoption. You have to be careful. It's still in early stage adoption. So you are not going to miss out on anything. So do not try to jump something where you think you're going to miss out. Right? This only tells you that no, you are not going to miss out. Cloud computing, but anyways, have been on to early adoption and innovators. Right? It's from there they have come. Social media again would have all of this would have been back. Right? Like for example, when you look at cloud, when you look at technology, Microsoft from peak to peak did not make any money. Right? Which means after the internet boom, it took them at least 13 years for them for the price, because the hype was so much for them to reach that particular point, right? And it's probably data. You can look at that particular chart. It's one of the best companies right now, right? So you're not going to miss out on anything. You have to be rational when it comes to investing in such themes. When you get to know such themes, you have to be rational as an investor, right? Now, when you're not rational as an investor, look at the result, right? Somebody said uh, in the chat saying Bitcoin maybe due to BTC ETF approval. Okay, all of this can take place, but there have been heads that have been backing, figures that have been backing certain sort of technology. So ARK Innovation ETF, right? ARK was one that took the internet by storm, and during the 2020 phase got a lot of steam, right? They were doing a lot of Bitcoin. They were talking more innovation. They were talking very futuristic. They had a very futuristic ideology, futuristic portfolios. They're all deep value. They're all highly risky. And look what happened, right? You saw in 2020 all the way till 22, it was highly celebrated. People were pumping money left, right, and center, saying, yes, we are in the future. The world is going to change. And now all of this works. So you saw that one particular phase where she came into the limelight, Art came into the limelight, and it sort of became a hero. So you look at what's happened after that. Look at what's happened when rationality has actually come up and taken place. This is where we had an irrational phase. Then we had sort of a rational phase. What happened in the rational phase? There have been deep corrections that came up in the rational phase. So if I just have to take 2020 all the way till now, it's one of the worst ETFs that's there. You can just type saying yes, and they've been one of the biggest wealth destructors as ETFs in the last 1 year, right? So uh, point is that when irrationality takes place, it's a choice. Do you want to jump onto that wagon or not? You're and is the question is that right now, is there irrationality in the global markets? Right. Definitely, there is some bit of irrationality that's there onto the global markets, okay, particularly in the US. Right. So if you see just from this chart, this shows that yes, there are periods of irrationality, but when rationality does come in, what happens after that? What happens after that is your result. You go through that bad phase and bad experience of that particular decision because you jumped the gun, because you tried to enter that particular party. So right now, definitely not the time. There are pockets. There definitely are pockets in the global space that warrant you to actually look at. So I've done a presentation on gold mining companies there in the US, for which Milestones2Wealth investors, Milestones2Wealth people who are on the program would know how much, whether it suits their appetite, whether it does not suit their appetite. But yes, definitely that sort of work has been happening for them, right? So there are pockets within the global markets for investors to take advantage of. Right now, that you have to be cautious when it comes to such hypes. My idea is to show you what hypes can create and what bubbles can do to you. Now, is growth broad-based, right? There was a question, right? Is it very broad-based? Now, if you look at fundamentals, right? Growth has been flat. Growth is continuing to be flat. Look at 2020, 2022, and the expectation is that if you take out Nasdaq 100, which is within Nasdaq 100, also there are just 7 or 8 companies that are contributing to that particular growth, right? So there is so this is just like 2018 in India, right? In 2018, performance was only coming from just the creamy layer of Nifty 50, right? Just the creamy layer, just the defense. Yes, as in not defense companies, but yes, people do think consumption are considered as defense, but it was just coming from a particular growth was only coming from a particular part of the entire index. Likewise, even here, you're not seeing broad-based growth that's happening, right? So if you see 22, 23, you're seeing flattening of growth, and then you see a jump when it comes from 23 to 24. If you add this sort of Nasdaq EPS, right? So within Nasdaq also there are just some companies that are contributing to that sort of growth. Which are these companies? So if you see the Magnificent Seven, right? Your Google, Microsoft, Apple, Nvidia, all of these have done phenomenally well. But if you see the rest, right? S&P 500 X, so which means 493 companies, 493 large companies, broad-based growth has not taken place. So would you want to jump this wagon, knowing that no, there are just particular parts of the market that are performing, both in terms of fundamentals and in terms of sentiment? So would you want to jump onto this wagon, right? This is the cost of innovation, right? Do you want to which side do you want to be on? So just put it in the comment box. What part of side would you actually want to be on, knowing that no, broad-based growth has not happened. We've just had concentration growth. And what has happened in history when concentration growth has actually come in? Okay, somebody said yes. Okay, somebody commented saying deep correction after concentrated growth. Okay. Okay. People move to contrarian investing. Okay, fine. Now that you've spoken about contrarian investing, we'll get to the next contra. It's very good. Uh, Mean reversion, broad-based, broader will do well. Mean reversion, broad-based doing well. Is it that the top would not do well, or is it that the bottom would go up? So, uh, or is it normalization from both sides, right? Where you would not, there will not be that deep of a correction, but things just stay as it is, like how we did in Japan. Things just stay how it is, where you don't make incremental, but it gives you good opportunities for 5 years to keep on consolidating at certain levels. Because if you look at the broad base, there will be times where you see no return, right? Uh, so okay, so yes, a good amount of views, right? Very drastic views, very different views. So naturally, yes. So it is open. We have to see what history has always spoken, that yes, there is some bit of you either don't see incremental returns, or you see as things get worse or fundamentally things can get bad. If things remain the same way fundamentally, then you don't see incremental returns that come in, right? So you're foregoing future growth. You are essentially foregoing future growth, right? Now, is that an opportunity? Uh, so anybody looking to do investments in the US, you have to be very cautious right now. Valuations are not very uh, conducive for you to actually go out and say, yes, I would take that sort of a call. You must have a 5 year plus sort of a building phase horizon, which means not to invest money for 1 year or 6 months or something. You must have a horizon to do saying, I will invest for 5 years, not ask for any return that comes in, and only then try to see what sort of developments actually take place. So you have to be cautious. That doesn't mean that you have to stay on the sideline. But naturally, you have to take a call saying, no, I want to stretch my horizon to invest. Right? I would invest for 3 years, 4 years or so, and then take a call of what I need to do. So which means that you don't have to see any, you don't have to judge it based on the performance. You have to judge it based on what's happening globally. Now, let's look at East. Let's look at what's happening. Somebody commented saying contrarian idea, and I thought that yes, we should definitely address a contrarian idea that's happening, that people are talking about. Naturally, you would get all these particular doubts. You would get it in the newspapers. So you should be aware of some data and what we are doing for Milestones to Wealth investors. What are we doing on the particular program? So I'll put the number at the end of the presentation also, where you can get in touch with us to know what we are doing on the program and to know what we can do for you. Right now, where's the next global opportunity? Is it China? Again, is it Japan? Is it Korea? Is it Indonesia? Okay, somebody said Indonesia. Japan. Okay. China. Don't know about the others. Okay. Korea. Okay. Everybody has one answer. Okay. China. Okay. Okay. So I think, okay, Japan again. Okay. So there's not a lot of data that's there for us on the Japan side. Let me just point out to you that when you look at specific parts of the Japanese market is when you start getting data, but you don't get broad-based proper data from the indexes, from the exchanges also. The only news that came in a couple of months back was Japanese exchanges scrutinizing the companies about their valuation and about how they cannot trade so cheap, knowing that there is having growth, having that sort of growth backing you for a long period of time. So definitely there's some scrutiny that's happening. So scrutiny is there everywhere, whether it's Japan, China, whatever the case be. Korea. Uh, uh, so today HDFC Bank is about 14% of the particular index, right? So who do you think is the largest weight, and what do you think is the largest weight in Korea? Right, and what actually drives the Korean economy? Uh, it's a good, you must see it. It's a good, I don't want to tell what is the largest weight, but it's very good. It's very good for you to know Samsung. You're right, it's Samsung. So definitely Samsung is a large weight, and Samsung contributes to a lot in terms of the Korea GDP. And then again, you have to look at semiconductor cycle to look at how to understand the Korean market. So it's a very good answer. It was very out clear answer for Korea. It was very good. We don't have an option, unfortunately, in India to invest in Korea. For Indian investors right now, there's no option. But hopefully something comes in the future, and we are able to get good data that comes in, good support that comes in from the AMCs and the distributors. Right? If influencers influence the Japan market nowadays, uh, 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 yes, Japan is in the rounds. Right? So let's look at China as a contrarian opportunity, because somebody commented, yes, China is getting very, very cheap. You don't know what it actually is. Right? So if you look at GDP in China, it has been slowing down, but it has been resilient. It has been slowing down, but it has been resilient. Right. So if you look at consumption, particularly, right, in China, has been extremely strong. Has been very, very strong, barring COVID. Barring the COVID years, it has been very, very strong. Right. Investment cycle started 2000, it went on till 2010. And after that, the cycle has sort of come off. Right. So you are coming off that period where you have a lot of infrastructure and not a lot of growth that is being contributed from that. There is growth, but naturally, when you're having this sort of oversupply, some you have to sacrifice certainly. But consumption has been very strong. If you see over the years, consumption growth has been very strong. So they've been contributing significantly. right? So YOY change also has been very, very strong. Now, China is in a transition phase. The economy is going through a transition. Now, I'll take you through these slides a little faster so that we can start the Q&A. But China has been going through a phase of going from old economy to new economy. Old economy was infrastructure driven, and new economy is more technology oriented, right? To support that sort of consumption growth, technology is needed, right? And what's been happening is that the revenue share that's been coming, state-owned enterprises are losing revenue share to all the private companies. It's a very similar scenario, right? Here we had a phase where public sector was not doing very well. Private was taking share from public. Now public is taking share from private. So here you're in the other scenario, right? Where old economy, there's a transition from old economy to new economy. New economy is more private, more technology oriented, and China runs the world in terms of technology. This is where we are in the Chinese economy. This is where we are in terms of China as an opportunity. It's in transition. So what do you do in a phase when there's transition? You either back it when it's too cheap, or you stay in the sideline. Now, let's look at tech. Chinese technology companies have done phenomenally well since 2010. If you compare it to S&P 500, Chinese technology companies has done extremely well. If you look at emerging market technology, not even close. Emerging markets not even close. But China as a whole industry, because it's more old economy linked, right? You're not seeing that sort of broad-based growth that's coming in. But one part of China has been growing significantly well, right? Both in terms of fundamentals and in terms of it's reflecting in the prices, right? It's reflecting in the sentiment. Right. So just look at the quote. We've answered skeptical questions about China for each of the past 17 years. It was bank balance sheets, it was trade wars, and throughout this entire period, the end result has been that China's GDP share relative to the US has gone up by 5 times. Right? So it has been proving, but naturally, the political scenario there is very different from that in India. Is very different from that in the US. Right. Naturally, you would see a lot of problems when it comes in terms of politics. So whatever is happening right now are all the scrutiny that's been taken place by the government for all these companies, right? But if you look at pure data, growth is there, and still, and that uh, sentiment is also following the particular growth. And you look at the sentiment now from 21 all the way till now, it has gotten very, very bad. So naturally, you're seeing China underperforming the entire world, right? You saw it in the previous slide, and you're seeing it uh, even now, right? Now, if you look at the Chinese internet index performance, you look at all of these problems. You had the new year and then gone. You had the antitrust guidelines for platforms, again gone. The ADR sell-off, again gone. So many issues. Just look at this relaxation of code, again problem. After that, only you saw some bit of growth, but again, all these overhangs that were there of the problem still came in. ADR sell-off, Alibaba fine, Meituan anti-monopoly issues everywhere. See the chart, issues. Right, there have been a lot of scrutiny, no support from the government whatsoever. Very similar, we've been in very similar scenarios like this in India, where there have been scrutiny that's been taking place, and then suddenly they leave their hand off naturally. Right? But this is the case in terms of why there has been this significant underperformance when it comes to Chinese index, right? They've been forced to sell. There has been concerns for delisting. Then there was the war, and again, developed nations are going through a slowdown. China again had their own slowdown issues. So deeper. That's what has happened on that entire place. So can it prove to be that sort of a continent area? Can investors take that particular risk, right? And if it stays or there's no sort of big improvement that comes in, when can you see that sort of thing? You naturally need to have a 7 or 8 year sort of time horizon, right, for you to weather through it and actually go out and commit more money to it, right? So Chinese equity valuations have been lower only in 4 episodes, right? 2008, 2011, 13, and now, right? Bottoming, is it a bottom? Definitely, if you look at history, if you see things are very, very cheap. It can get cheaper from here, but the whole point is is that we have not had such scenarios a lot in the past. We've had scenarios, but if you look at how valuations have been playing out, we've seen this scenario only 4 times in the past, right? Now, Chinese, the tech companies, right? This is one of the Chinese ETFs as I saw public data. This again is sort of getting very cheap. Again, Chinese technology, that is what drives innovation, where the support has to come from in terms of more consumption growth, where the new economy is actually, that's getting a lot more cheaper. So you're seeing plus points everywhere, but also you're seeing fear, right? Usually in this scenario, you don't have you have fear to commit, right? Naturally, that fear sort of comes in because you're having this hindsight bias saying that no, things have not happened well before. Can things happen? Can things go around becoming very good in the future, right? So that's why these are cases that come up for you, right? Where you see contrarian ideas coming in, and what do you do at that point of time? Uh, uh, History has shown that if you do participate, things do change, uh, you know, 5 years, 7 years down the line. But right now, there are so many issues that are taking place there. All the other checkpoints, right? This, your US macro scenario and your China macro scenario, this is not in favor, right? That's why you have to sort of stay on the sidelines when it comes to investing globally. But there are pockets where you're sort of making that, where you can hedge yourself against all the problems that can come in. Right. This is where the other parts of the uh, ideas do come in for uh, gold mining, and milestones to where investors would know what we've been doing for that. So now I'll open the floor for Q&A. We have a good 5-7 minutes for Q&A. So I've put the number here also. Do get in touch if you want to know more. If you actually want to participate, we'll do something for your risk profile, and we'll be able to build a good position for you on the global side. So now I'll open the floor for Q&A. And if you want me to explain a particular slide again, do let me know. I can go back there and probably explain it better. Best way to invest in these Chinese tech companies, there are ETFs and fund of funds in India where you can take that call. But again, depends on your risk profile, depends on how much of it you can, you have the ability to weather. So to know whether you have that sort of risk appetite, whether you have, uh, you know, things that can work in your favor, you can get in touch with us. We can help you, and we can see whether it actually fits into your risk profile and whether you can do it going further. So there are efforts in India. Is Indian market safe and better compared to global markets currently? India is trading at a premium to the global market. India is trading to a very high premium, whether it is China, whether it is Japan. India is trading at a premium to even the US. So you have to be very careful now when you have to be cautious when you invest in India. SIP is the best method for Indian investors to invest in India. SIP is the best. So gold mining stands a better chance from near term than other global areas. See, you have to. So I've done that presentation, and if you do, you can just send a hi saying, you can just message us saying hi. I want the link for the gold mining presentation, and somebody would send you the YouTube link. But we have not seen performance coming in from gold mining in the last 4 years, right? So cheap has become cheaper and continues to become cheap, right? So naturally, when you commit to sort of such contrarian ideas, like again, there's China. When you commit to sort of content analysis, it tests your patience, and it will test you going forward as well. It will start testing your conviction, it will start testing your patience. And that's why we are there here, right? That's why we are there here to guide you and help you, saying for your risk profile, for your appetite, for your goals that are there, does this suit you or does this not suit you? Right. So fundamentals speak a different language and sentiment speaks a different language. Until and unless sentiment supports that fundamental, you will not see anything reverse. Right. That's what it takes for contrarian ideas, and it tests your patience. It tests your patience very, very badly. From the value perspective, China seems to be a good continent, but there's also a statement that there is no real return made in investment made in China, as people are not able to take the money out because of the company structure. Exactly, you're right. How true is this statement? And won't neutralize the opportunity created because of valuation. No, you're right. They actually don't. So whatever is listed on China, that is called onshore, uh, that is the actual ownership that you're getting. So here, when you buy stocks, you're getting ownership, right? There, you are not getting that sort of ownership. There, it's just a warrant, right? You're not actually getting that sort of ownership, and that's why there was this problem of. Uh, That's why there was a delisting concern, right? They wanted all the companies that were listed in the US to come and start getting listed again in Hong Kong. That's the Hong Kong index, right? But yes, that's there, but it's already sort of factored in. So this is not today. This has been there from the beginning, right? The ownership structures have always been more that this is they claim it to be uh, uh, for defense. They claim it to be to safeguard the country's interests, but this has always been there. It's not today. This has always been there. So all the problems. So then there should not be the cause of it outperforming everybody else. But there's always been that sort of problem. So it won't neutralize the opportunity created. But right now, this valuation is only because of the sentiment and negative. This is again such a broad-based political agenda that's there when it comes to China. Everybody wants to go away from China, and for how long can they be away is the question. Because a lot of infrastructure developments take place, a lot of demand comes in from there, a lot of supply also comes in from there. That's where it's a tussle. So, do you want to participate in a tussle? Can you take that risk? If yes, how much of that? That's what we are here for. But yes, you're right. I think you've been tracking all these things very closely, which is very good. Thank you. Thank you. If you want a particular topic that you want to address, just send us a hi, just message us saying, these are topics that, you can cover. I'm very open to feedback. You will also get a feedback from if you're on the program. Do get onto the program. We do a lot of more activities when you're on the program. If you're not on the program, then, you might miss out. The only thing that you might have access to is things that we put out on social media. But get onto the program. That would be very sure. Right now, we are only talking about equity and gold. Now we are talking about global. So we are getting more and more opportunities for Indian investors to participate in. We are educating investors. Debt again is a very good opportunity for investors to invest in. I did a webinar last week for debt, and I would continue to start giving options for debt. But if you're on the program, it would be much more beneficial for you. This is just a very small portion of what we are trying to do on the program. Is it better to wait or invest in the stock market? Not in SIP. SIP you should do in India. You should not leave out your SIP. I don't think that you should leave out your SIP at all. SIPs are the best way for Indian investors to invest in. It's very, very clear. 50 lakh crore is the AUM size. And SIP numbers are very, very strong. SIP is something that you have to do now. Second, where should you do SIP? That's your question that you should answer. And for that, get in touch. We have done many webinars on where the opportunity lies in India. Right, so get in touch. With taxation as per one's income tax slab, is it good idea to invest in a fund of fund? When you invest globally, again, the fund of fund tax is like a debt tax. So you can treat this as a debt fund. That's it, debt fund tax. There is an overlap of the weekend programs, so I thought with respect to timing, please have one after the other. We are having already one after that. Now, problem is that we have a lot of events that we're wanting to do. Weekends are the only time where sort of everybody is free. They are available. We can do things on the weekday. If we do give out an invite on the weekday, please turn up, because we've tried to do things on the weekday, and responses have not been that great. So everybody is busy on the weekday, right? I can't expect everybody to come back from work and still have the mindset of a work. You should come back from work, spend time with your family, do a lot of other things that you have goals for. But yes, this feedback has been received multiple times by us. But thank you so much for this feedback. Yes, there is an overlap. We are very aware. So we're trying to curate events. We're trying to curate webinars specifically for particular themes, particular questions, particular investors. So get in touch with us. We'll tell you what can suit you. Also, something that you should attend from your side. Right. In fact, because of the overlap, I'm not able to attend the other events also, which I'm interested in. And I thought there was a good event that took place at 10 a.m., which I was not able to attend. So I have to go back and check the recording. But anyways, I think we are out of time. But thank you so much for spending time with me on a Saturday morning. Do get in touch with us, get onto the program. There's a lot of other things that we do on the program. And we're doing things as per what is suitable for you, not a template, not a particular t-shirt. It's tailor-made for you. So get onto that program. Do text us, just send us a hi with whatever feedback you have, with whatever topics that you want us to cover. Get in touch with us and we'll do our best to sort of address it. But get onto the program because there's a lot more interaction one-on-one, which is going to be very beneficial for you. Yeah. Thank you so much. Have a great weekend ahead. Thank you.